Yo, what's going on, guys? Welcome back to day 5. Today we're going to be going over understanding like certain key levels and just kind of the difference between retail concepts versus, smart money, institutional kind of order flow, right? ICT, stuff like that. So this is probably going to be a shorter video compared to the last ones because I just want to go over kind of what key levels are and how you can, spot them or use them in your trading. So if you haven't already, please make sure to go ahead and subscribe to this YouTube channel and leave a like on this video if you find it helpful. I would also go back and watch the previous videos as well, day 1 to day 4 if you haven't. If you're new to this channel, definitely go check that out. It wouldn't really make sense to start on day 5, so take the time. If you really want to learn this, take the time and go back and watch day 1, 2, 3, and 4, and then you can come back to this video. I promise they're not even that long of videos. They're quick. Go ahead and take your notes on them, and I promise it's going to help you a lot. But there's only so much you can do with this information, so you got to go in and actually apply it on the charts for yourself, back test, see what works, see what doesn't work. It's all up to you at the end of the day. Don't take what I'm giving you, as something that you should just use. Test it out for yourself, okay? Because at the end of the day, that's what's important, is testing all the theories out that I give you for yourself. So without further ado, let's just go ahead and get into the video. So today, like I said, we're going to be going over understanding key levels, retail versus institutional concepts. So first off, what can we kind of identify as key levels, right? So if you look at basic retail type concepts, people who trade supply and demand, stuff like that, support resistance, the basic definition for key levels in this sense is support and resistance, right? So you have what's called a floor or a ceiling, right? So if you go ahead and look on a chart here, right, you'll notice that there's a lot of areas in price where you'll see reversals, or areas of price where it'll take out some sort of liquidity, go in one direction, right, hit some sort of another key level, and then start to reject off that. So it's not necessarily just like reversals, but it could be reversal depending on what time frame you're looking at, right? Because if you're looking at this wick down here into this gap here, taking this low, this on a very low time frame, like on a 1 minute, will look like a reversal, right? Because all this, price is fractal at the end of the day. So it really just depends. But key levels are areas in price where you could expect something to happen, some sort of activity, right? So if we go back over here and look at support versus resistance, okay? Support is going to be like, as it says here, what I wrote here, the floor, right? So support is going to be somewhere where price finds what it sounds like, support. So right here, you see we sweep out this liquidity and we find support in this area, which pushes us back up, right? And now we took out this liquidity and we left this high here. So now this is your point of resistance. So the way you can think of it for, from a retail perspective, support's on the bottom, resistance is on the top, right? There could be support turn resistance, resistance turn support. That's not what we need to learn. I'm just showing you the differences just so you can be educated on the topic, okay? So support, resistance, we got that out of the way, right? So how do retail traders identify these key levels, okay? Well, most retail traders, they'll look at, historical highs and lows, right? Which means highs and lows from the past. They'll look and see how they respect off those areas. A lot of retail traders will see a low like this get swept, and they'll end up assuming that, it's probably going to break, retest, and then continue lower. But a lot of the times, if you're a smart money concepts trader like I am, or ICT, whatever, most of the time, if the drawn liquidity is higher and we sweep below, it's going to go up, right? A lot of people have it kind of backwards. So it's almost like retail concepts are the complete opposite of smart money. But there are a couple things in terms of retail that align with smart money. So that's basically that, right? The historical highs and lows, right? Look left on the chart, of course. Trend lines connecting key points. So trend line, what I mean by that is, a lot of these people who trade retail concepts will see, something like this, and they'll expect this to continue to hold and then go lower, lower, lower. But for us as smart money traders, we see these trend line as low resistance liquidity runs, which I'll get into later in this mentorship. But it's like I said, it's the complete opposite, right? These trend lines are filled with stops, so it's most likely just going to go up and run those, right? Trend lines connecting key swing points, right? There's swing points in every one of these areas, right? Swing high, swing high, swing high, swing high. They're lower than each other, right? So those levels, like I said, retail people see these as protected, I guess, and they'll expect price to go lower, not taking out these highs. And then also psychological levels. right? Round numbers, $100, $1,500. What I mean by that, if you look over here, right? Let's say 21,700, right? People might expect this to be a point where it'll hit that and then reverse. But a lot of the times that doesn't really matter. The draw on liquidity is going to be the draw on liquidity. So regardless of what people may think is a psychological support level or resistance level, it's most of the time not really going to respect it. Of course, there are points in the chart where it will, bounce off of like 21,042 even, and then it'll be like, okay, this seems pretty algorithmic. But most of the time, it doesn't do that, right? A lot of people think the market's random. It's not random, but in terms of certain areas and price, when you're actually looking at price here on the y-axis, you can't really look at it in a sense of psychological numbers. For trading Bitcoin and other crypto things like that, sure, it definitely helps a lot, because on Bitcoin it hit a high of like, I don't know, 109 or something, and then of course everyone decided to sell their bags, because when everybody figures out about crypto, when the news is out about it, that's when everybody starts buying, and then that's when the whales and everybody who's actually in that crypto cycle and they understand it, that's when they sell their bags, right? So that's besides the point. We kind of went over this. Hope you guys understand that. It's quite simple. Again, this isn't really something that you would use. I'm just trying to give you the education on it to understand how you can do the opposite of what most people do who fail in this space, right? So if you look over here, right, institutional concepts, liquidity, and order flow, right? So what institutions focus on mainly, right, are liquidity pools, which are clusters of stop loss orders above resistance or below support, right? Order blocks, areas where smart money entered significant buy or sell positions, and imbalance zones like fair value gaps, which we went over in the previous video, where price may retrace to fill. How do they view these retail levels, right? Retail support resistance is often just a stepping stone for their larger moves. Institutions use these levels to trap retail traders, false breakouts, or just overall fake outs in general, right? So a lot of the times, if we're talking about liquidity, like I told you, smart money and a lot of these big institutions have stop loss orders sitting at highs and lows, right? So what you could expect, if you're doing your analysis correctly, a lot of the times when sell side is swept, you're going to be looking for longs, right? If buy side is swept, you're going to be looking for shorts. So like I mentioned previously in this video, a lot of times people will see a sweep of liquidity and expect price to go lower. But over time, if you keep learning, that's truly not the case. Sometimes you'll get a sweep of liquidity, and then if the draw is lower, it'll actually continue to go lower, or vice versa. But I mean, most of the time, most people kind of have it all backwards. So in my personal opinion, I think smart money is the best way that you can go about trading and learning how to take good trades and just overall understand how the market moves, right? So if we talk about order blocks and imbalance zones, right, these are key levels in it of themselves, right? Because if you look over here, right, we have a fair value gap over here, right? And keep in mind, we're on the 1 hour time frame right now. This here is a key level, okay? Understanding these key levels is very crucial, right? So if you look at this in terms of like support and resistance, we tap a gap, we try to bend to it and show hesitancy to go higher, right? So this would be a point of resistance because we're resisting to go higher off of this level here, right? Same concept goes if we're looking at a support zone, right? So if you look, right, you'll see we have a gap here as well, right? And although we did break through it, there's still hesitancy to go lower, right? Although we had this big displacing candle, it's hesitating to go lower. So that's your support, right? So you have a resistance up here and support. And a lot of the times you're going to spot key levels inside of these gaps. And also, like I told you here, within order blocks as well, right? So there's liquidity pools, there's order blocks, there's imbalance zones, and there's other key levels that I'm going to go over later on in this mentorship. But like I said, I want to keep this specific video short and concise so you guys can understand what I mean exactly, but what key levels are, right? So like I said, liquidity pools, order blocks, and imbalance zones. So these are imbalance zones, which is the same thing as a fair value gap. An imbalance is a fair value gap, okay? Don't let these concepts and all these different terms mix you up and confuse you, okay? So key level, right? Bearish key level, bullish key level, resistance, support, right? Same concept goes for order blocks, right? Remember, if I told you about the last video, remember what I told you about the wicks, right? If you look, this wick is an order block, right? Because we opened, printed a low, and then immediately traded back higher. So we marked this out, and you'll see, look at that. The body of this candle closed right on the midpoint of this, which is mean threshold of the order block. This is I guess what you could call a support key level, right? Or a bullish key level, right? It doesn't really matter concepts all mean the same thing. They're just rebranded by tons of different people, right? So don't confuse yourself with that. Bullish key level, right? Same concept applies for a bearish key level, right? If you look over here, right, we have your high over here, whole leg here. You can move this as an order block, right? And you'll see this price is hesitating to go through because look, we have this huge key level here, this gap, and inside of this key level, we also have this order block, right? And if you look, if you go down to like a 1 hour, this key level is showing us, this order block is telling us, okay, we're holding this. And there's also another key level inside of here, which is this gap, right? If you look, boom, this is the other gap that you're looking at as well. So that's another key level that you want to look out for. So mainly just order blocks, fair value gaps. Those are specific key levels that you really want to look out for. So that's all I really look for when I go into intraday analysis, is looking at key levels. What did the overnight session do, right? What did Asia session do? What did London session do? How can I use that to frame my buys coming into the New York session, right? So that's all I really mean by key levels in terms of liquidity pools, order blocks, imbalance zones. So so how do they view these retail levels? Well, retail and support resistance is often just a stepping stone for their larger moves, right? So institutions use these levels to trap retail traders and create false breakouts or fake outs. So that's exactly what I meant by seeing something like this. They might see a break, right? And they might see lower prices on the left side of the chart. But in this case, most people don't know that this is a bullish order block or a bullish demand zone. And a lot of people will see this as a break. But in reality, these big institutions pose this as a false breakout to the downside. And then, of course, look what happens, right? They get stopped out and it goes in the other direction. So this happens on every single time frame, every move, basically every single move on the chart, right? Even if you look on the 1 minute time frame, right, you could just see in all these specific levels, right? People might go long here, boom, they get stopped out, right? People might go long here, boom, they get stopped out. So it's all about being patient and waiting for these certain key levels to play out and get hit first before you actually make that decision in, figuring out where you think price may go. But again, it's not about predicting where you think price is going to go. It's about reacting off of the confluences that you see, which in long-term sense, those probabilities will add up. And over time, you shouldn't care about a loss because, it's in the long run, it's going to make you profitable. Even like in a week or 3 days, 4 days, 2 weeks, a month, you're still going to end up profitable, right? So that's what I mean. So understand how these retail people operate and just do the opposite, basically. But again, there's going to be a lot more covered in terms of key levels and, just everything that you need to know how to trade the right way to end up being profitable, okay? So again, the key difference is, right, retail, they focus on visible patterns, right, and static lines. They don't really think about the whole narrative backing of it. They don't think about drawing liquidity. They don't think in terms of logic. They think mostly in terms of emotion and just psychological levels that most of the time never hold, right? So that's really important. I'll again, take notes on what I'm talking to you about here. And don't be lazy with the notes. Just take those notes and seriously just lock in with this, okay? But if you look at institutions, right, they focus on hidden intentions and like exploiting liquidity and creating imbalances. So hidden intentions is, I guess, kind of what it sounds like, right? They focus on areas in price where retail traders might think otherwise, but for the most part, these levels will not work for these retail people, and they'll just get ran through, they'll get stopped out, all these different things. So it's crucial to understand how these institutions play, how they make their moves in the market. And if you could follow them and get really good at it and understand how these markets actually move, it's going to be, quintessential for your success in trading. So yeah, let's see, takeaways for your trading. So again, stop thinking of key levels as static because they're not static, okay? Think of them as zones of activity. Like I said, activity. You want to wait for these key levels to get met and react off of what you think makes the most sense in terms of drawing liquidity and the overall narrative, and just overall being logically backed, right? And not just being an emotional mess, okay? And obviously that comes down to identifying high probability days and knowing when and when not to trade, stuff like that. So yeah, so again, watch for signs of manipulation around retail key levels, obvious retail key levels, fair value gaps, order block, liquidity, right? Wicks or breakout and reverse moves. Again, wicks like order blocks like I showed you here, right? all these different things. Study these concepts like liquidity grabs, order blocks, and balance fills to get more of an institutional perspective. Again, backtest, understand these key levels, know when to take trades off of these. It's gonna come with repetition, right? You're gonna learn a lot from failing, right? Of course, it's good to win. It's that nice dopamine rush you get, and of course, losing sucks, but losing is what's gonna make you grow as a trader. Okay, so again, like I said, I'm gonna keep this very small or very short and simple. That's really all I got for you guys today. Tomorrow, I'm not gonna tell you what we're gonna go over tomorrow. That's a surprise, but that's really all I'm going to leave you guys with this. This is probably going to be, one of the less important videos. Of course, it's still important, but this is going to be, like I said, a shorter video, and just overall have a good understanding of this. And once you have a good understanding of the difference between retail concepts and just institutional or smart money concepts, it'll give you a better understanding of how to take very high quality setups instead of just, taking trades that don't really make the most sense. Again, a lot of people think the market's against them, or the market makers are hunting their stop losses, and in a sense that is true, but you have to learn how to play these guys. You have to learn how to not be trapped into being that stop loss or being that liquidity. So yeah, that's really all I got for you guys today. If you guys enjoyed, please go ahead and leave a like on the video, subscribe if you haven't already. And again, like I said in the last video, if there's anything you guys don't understand about this specific video, leave a comment down below, I'll make a video on it to help you guys understand it a bit more and just give it to you guys in even a more simplistic way. So yeah, I'll catch you guys tomorrow, and we got a new trading week ahead of us. Tomorrow's Monday, so yeah, it's gonna be a great week ahead of us, hopefully. Follow your rules, stick to your plan, be disciplined, and you're gonna have a great week. All right, boys, I'll catch you on Monday. Peace.